News about the stock market is in the headlines these days. You can't turn on the television, pick up a newspaper or check the daily news on a website without hearing or seeing reports about how the stock market is doing. If you've never invested, all of the names and numbers you're hearing about might seem like gibberish once you put on the time and do the research. However, you can unlock the meaning behind them all. If you want to learn about what stocks are, how to invest in them, and how they might play a role in your investment plan, stay tuned for a beginner's guide. What is a stock? A stock represents ownership in a company. If you buy 100 shares of Facebook, for example, you actually own a portion of the company, just like founder Mark Zuckerberg. Although your share would be infinitesimally small, Facebook has roughly 2.38 billion shares outstanding. You would still participate in the same percentage of profit or loss as every Facebook shareholder. The stock numbers you see quoted in the financial news represent the price of one share of stock. If Facebook stock goes from $100 per share to $102, for instance, every Facebook stock owner gets the same 2% gain in his share of its holdings. Opening an investment account. To begin investing in stocks, you'll need a broker. You might choose a full-service broker with physical branches, such as UBS, or an online broker, such as TD Ameritrade. To open an account, you'll have to supply personal information, such as your name and address, date of birth and social security number, plus financial information, such as your bank name and account number. Before you begin investing, your broker will ask about your investment experience, what your financial objectives are and how much risk you are willing to accept. As a beginner, you might want to actually speak with a broker because you probably don't even know the answers yourself until you talk the topics through. Note that many online brokers, such as Fidelity, have both phone agents and brick-and-mortar locations where you can talk to live investment representatives. Today, many full-service brokers like Merrill Lynch also online brokerage divisions as well. Once your account is open, you'll have to fund it. Requirements vary by broker, but you can typically make deposits via check, wire transfer or electronic transfer. Where to buy stocks? When it comes to where to buy stocks, your choices include online or from a full-service broker. Although many online brokers also have physical locations and many full-service brokers allow customers to make their own purchases online, here are the main differences between the two. Online brokers. Online brokers are for do-it-yourselfers. You enter transaction online, but office or phone transactions might be available for additional fees. You'll generally get low-cost trading, such as $4.95 with Fidelity and $0 with Robinhood. You'll have access to online services such as investment research and portfolio allocation tools. Full-service brokers typically charge a high fee per trade. You'll be privy to a wide array of professional investment services, from trust and estate planning to insurance and retirement offerings. A full-service broker will typically provide you with a personal broker for one-on-one advice. Full-service brokers, in the simplest terms, full-service brokers provide a wider range of services and more professional hand-holding for nervous or inexperienced investors, but these services come at a higher cost. Online investing is easy, efficient and inexpensive, but you have to know what you're doing because there aren't as many safeguards to prevent you from making bad trades. How to buy a stock. If you're working with a broker, you won't be entering a trade yourself online. Instead, he will enter the trade for you. Tell your advisor the name of the stock and how much you want to buy, either in terms of a dollar amount or the number of shares. If you're entering your own trades, you'll have to do a bit more legwork. Here are the steps you'll need to take to enter stock trades online. Log into your online account. Look up the symbol of the stock you want to purchase, which you can find online at any number of financial information sites. Enter the stock symbol and the number of shares you want to buy. Choose whether you want to enter a market order, which executes immediately, or a limit order, which specifies the maximum price you are willing to pay for a stock. Review your trade, including the total anticipated cost. Select the correct button to buy your stock, which can vary from company to company. Typically, it will be labeled buy, purchase or execute. After you enter your order, wait for confirmation from your broker. If you work with a full-service broker, he will usually call you. If you choose an online broker, you'll typically get confirmation via an online notification and an email. How to invest in stocks. Investing in stocks involves taking a long-term approach to generating profits. Stocks can create profits for shareholders in one of three ways: via capital growth, income, or a combination of the two. Stocks provide capital growth when their share price rises in value. Let's say you own 100 shares of a stock with a $100 share price, for a total investment of $10,000. If that stock rises to $150 per share, your original $10,000 investment will be worth $15,000, a 50% gain. Keep in mind that the stock market has averaged a return of about 10% a year over the long run. Some stocks aren't expected to make big profit gains in the market but instead pay large dividends. A dividend is a regular payment to investors, typically made quarterly, that comes out of a company's profits. Income stocks are often available from firms that have stable earnings and dividends, like utility companies. An income stock might pay 5% or more in annual dividends to stockholders. Some stocks share both growth and income characteristics, paying a dividend and offering a good potential for share price gains. These types of stocks typically come from older, well-known companies in reliable industries. Think Apple, that might not generate a startup's level of growth but still generate tremendous profits. When investing in stocks, consider which type of stock best suits your investment strategy. Well-diversified portfolios might include a combination of all three types of stocks. How to trade stocks. In colloquial terminology, trading and investing in stocks are used interchangeably. In the investment world, however, they carry distinct meanings. While investing in stocks carries the connotation of a long-term holding period, trading stocks represents darting in and out of stock positions in an attempt to generate quick profits. As such, trading stocks isn't really an activity for beginning investors, but there are times when trading might be appropriate. You'll follow the same steps for trading stocks as investing. When a stock has generated a quick profit, you'll enter a sell order, which is like a purchase order. You might also enter a sell order if a stock hasn't moved as anticipated over a short period of time, or if it has temporarily traded down. The difference between an investor and a trader is that an investor has a long-term view and will ride out the short-term fluctuations of a stock, but a trader lives and dies by those short-term fluctuations. If a stock rises quickly, a trader will bank the profit. If a stock begins to fall, a trader might immediately sell the stock to avoid further losses. The investment philosophies differ, but the steps to actually buy and sell remain the same. Investing in stocks for beginners. Before you buy an individual stock, research the reasons why the share price might go up or down. Just because a company has a name you know or creates a product you like doesn't mean that the stock will earn you any money. Twitter is a perfect example of this. Twitter has about 330 million daily active users, but even after a significant stock run-up in 2017, the stock is still below its 2013 initial public offering price of $26. Trading at $24.04 as of January 18, 2018. During that same time frame, the stock market overall posted huge returns. When choosing which stocks you might want to buy, ask these questions. What are the earnings projections from stock analysts and the company itself? Is the company's management performance good? What are the profit trends in the company's industry as a whole? Does the company's prior earnings history typically beat its earnings expectations? What is the current price-to-earnings ratio in the industry average price-to-earnings ratio? How are the general stock market conditions and the current interest rate environment? Many other factors go into stock selection, including geopolitical concerns, levels of investor optimism or pessimism, corporate insider stock purchases or sales, and stock price volatility, to name a few. Because some of this information is difficult or even impossible for an individual investor to look up, most professionals recommend against putting all of your money in a single stock at a single time. Crafting a diversified investment portfolio. When it comes to investing, think in terms of a portfolio. rather than a single investment. Although stocks have the potential for sizable gains, they also carry a higher level of risk than many other types of investments. Modern portfolio theory demonstrates that a diversified portfolio can help reduce that risk. Diversification refers to the addition of different types of investments to help mitigate the risk that comes with having all your eggs in one basket. You can diversify your portfolio by buying additional stocks that don't necessarily trade in tandem. For example, if own a tech stock like Facebook, you might add consumer products, oil services and public utility stocks to diversify your holdings. Another way to diversify your portfolio is to own different asset classes. For example, if you add some bonds, mutual funds, exchange-traded funds and precious metals to your stock investments, it's likely that portions of your overall portfolio will rise while others are falling, which will reduce your account's daily fluctuations. You'll have peace of mind and you'll likely stick with your investment plan instead of selling assets out of fear. Dollar cost averaging for beginners. Even investment professionals with years of experience can't tell you where the market will go in the next day, month or year. The SEC even requires mutual funds to include a disclaimer for investors that states past performance is not a guarantee of future results. The long-term trend of the stock market is up, however, as companies continue innovating, bringing new products to market and generating more sales. Over time, company earnings are one of the primary drivers of its stock prices. Because even professional money managers struggle with timing when to get into and out of the market, the best bet for beginners is to invest in the market regularly. Financial services firms make this easier than ever with automatic transfers from your bank account to your investment account. By buying into the stock market regularly, you'll automatically buy more shares when the market is low and fewer shares when the market is high, a process known as dollar cost averaging. Over time, a regular investment program can help smooth out the market's volatile ups and downs. Get started today. Investing in stocks takes research and dedication, but it can be a great way to generate profits and save for long-term goals, like retirement. Balancing your stock investments with other assets can help reduce the volatility of your portfolio and keep you invested. Automating your investing and dollar cost averaging can help ensure you're saving regularly and can protect you from trying to time the market. The process of actually buying stocks is straightforward, but do your research first and talk to an investment advisor if you need a helping hand.